Higher highs and lower lows are the market's language, and like any language, it only sounds confusing until you stop trying to translate it into what you want to hear. The market doesn't speak in words, forecasts, or opinions. It speaks in movement. Every tick, every swing, every pause is part of a sentence being written in price. And once you learn to read that sentence, trading stops feeling random and starts feeling structured. When a market makes a higher high, it is telling you something very specific. Buyers were willing to pay more than they were before. When it follows that with a higher low, it tells you something even more important. Buyers were unwilling to let price fall back to the previous level. That's not emotion. That's behavior. And behavior, repeated over time, becomes information you can work with. Do you notice how little interpretation is required when you look at it that way? Most traders complicate this simple message. They decorate charts with indicators, draw endless lines, and still miss the one thing that matters most: direction. The market doesn't hide direction. It reveals it openly through structure. Higher highs and higher lows mean accumulation. Lower highs and lower lows mean distribution. Everything else is commentary layered on top of that basic truth. I learned early that the market rewards those who listen, not those who argue. When I saw a stock continue to make higher highs, I stopped asking why it was going up. That question is usually asked by someone looking for a reason to sell. Instead, I asked whether it had stopped going up. That's a very different question, and one the chart can actually answer. As long as the structure remains intact, the trend remains intact. Lower lows work the same way, just in reverse. When a market breaks to a new low and then fails to recover meaningfully, it's telling you sellers are in control. Not temporarily, not emotionally, structurally. Each failed rally becomes evidence. Each new low confirms commitment. That's the market communicating clearly, without drama, without explanation. The problem is that many traders want to trade words instead of structure. They want to trade news, opinions, and forecasts because those feel intellectual. Structure feels too simple, almost dull. But simplicity is where consistency lives. The market's language is blunt. It doesn't care how smart you feel. It cares about who is willing to act at higher prices and who is willing to accept lower ones. There's also a psychological comfort in ignoring structure. If you believe the market is driven by stories, then losses feel unlucky. If you accept that the market is driven by structure, losses feel instructional. One blames chance. The other points to misreading. Which one helps you improve? When you trade using higher highs and lower lows as your guide, you stop chasing perfection. You're no longer trying to buy the bottom or sell the top. You're trying to participate in continuation. Continuation is predictable because it's based on what has already happened, not what might happen. The market has already proven it can move in one direction. You're simply asking whether that proof still holds. This approach also forces discipline. You can't argue with a higher low without arguing with the chart itself. You can't justify a countertrend trade without admitting you're stepping outside the market's current language. That honesty changes how you manage risk. Stops become logical, not emotional. If a higher low is broken, the language has changed. If it holds, your position still makes sense. Many traders say they understand trends, but few actually trade structure. They recognize direction only after it's obvious, then abandon it at the first sign of discomfort. Discomfort is not a signal. Structure is. A pullback that holds above the prior low is not weakness, it's confirmation. A rally that fails below the prior high is not strength, it's warning. The market is constantly talking. Are you reacting to tone, or are you listening to words? This is where patience becomes a technical skill, not a virtue. Waiting for a higher low to form before entering keeps you aligned with the market's grammar. Entering before that is guessing. Guessing might feel bold, but it's rarely consistent. The trader who waits is not slower, he's more precise. There's also a lesson about ego here. Accepting higher highs means accepting that price can go higher than you think is reasonable. Accepting lower lows means accepting that price can go lower than feels comfortable. The market doesn't care about your sense of value. It cares about pressure. Higher highs mean upward pressure is winning. Lower lows mean downward pressure is winning. Until that changes, your personal valuation is irrelevant. Over time, you begin to trust this language more than any single indicator. Indicators lag, structure leads. Indicators describe what has happened. Structure shows what is happening. That distinction matters when real money is on the line. You don't need to know how far a move will go. You only need to know whether the market is still speaking the same way it was before. This understanding also filters opportunities. Markets without clear higher highs or lower lows are undecided. They are conversations, not statements. Trading them requires guessing which side will speak louder next. Trending markets are statements already made. They say plainly, this is the direction of least resistance. Why fight clarity? As you internalize this, your trading becomes quieter, fewer trades, clearer reasons, less stress. You stop feeling the need to explain every tick. You stop feeling insulted when price moves against your opinion. You simply note whether the structure has changed. If it hasn't, you wait. If it has, you adjust. The market's language doesn't change suddenly without warning. It stutters first. Higher highs become harder to make. Lower lows lose momentum. Ranges tighten. Those are shifts in tone before shifts in direction. And if you're fluent in structure, you notice them without panic, without excitement, just as information being delivered in real time, one swing at a time, shaping the next decision you'll have to make. Not because you feel compelled to act, but because the market has said something new, something different, something that no longer matches the previous sentence it was writing, and now you are faced with the task of listening carefully enough to recognize whether this is a pause, a hesitation, or the beginning of an entirely new statement. Trends reveal where real money is committed, and that's not a theory I picked up from clever talkers or tidy textbooks. It's something you see after you've watched the tape long enough to recognize when prices are being pushed with purpose. Small traders don't create trends. Crowds don't create trends. Trends are born when capital with patience and size begins to move, and once that movement starts, it leaves footprints all over the chart. The market doesn't whisper when real money shows up. It speaks plainly if you know how to listen. Most people think trends happen because of news, earnings, or stories that sound good at dinner. Those things may start interest, but they don't sustain motion. Sustained motion comes from commitment. When institutions decide to build positions, they can't do it in a day. They buy on weakness, they absorb selling, and price slowly lifts itself higher. That lift isn't excitement, it's pressure. And pressure, once applied, doesn't vanish easily. Have you ever noticed how a market keeps rising long after the news stops being exciting? That's real money at work. It doesn't chase headlines. It builds positions where risk can be managed and exits where liquidity exists. You can't see the orders, but you can see the effect. Higher lows forming quietly, pullbacks that don't break structure, breakouts that hold instead of collapsing. Those are not accidents. Those are decisions made by capital that plans to stay. A trader who understands this stops trying to predict and starts trying to recognize. Recognition is calmer than prediction. Prediction demands certainty. Recognition only demands honesty. Is the market advancing with ease? Is it resisting decline? Is volume expanding in the direction of the move? These are not questions of belief. They are questions of observation. And observation is where predictability begins. When a trend is real, it doesn't need your encouragement. It moves whether you participate or not. That's an important thing to accept, because it removes the feeling that you must act. The market doesn't need you. Your job is to decide whether you want to align with what's already happening. Are you trying to lead the parade, or are you willing to walk in step? I've seen traders lose fortunes trying to outthink capital that dwarfs their own. They believed that because a price looked too high, it must fall. But prices pushed higher anyway, not because logic failed, but because commitment outweighed opinion. Real money doesn't exit because something looks expensive. It exits when demand weakens and structure breaks. Until then, it stays put. This is why trends are such powerful teachers. They show you where confidence exists. A rising market tells you buyers are willing to pay higher prices repeatedly. A falling market tells you sellers are eager to accept less. That behavior repeats until something significant changes, and when it does change, the chart shows it first. Not the commentary, not the explanations, the price. Many traders spend years searching for indicators to reveal secrets while ignoring the most obvious signal of all: persistence. Persistence of direction is commitment made visible. It's not dramatic, it's steady. It shows up as a series of advances that don't fully retrace or declines that fail to rally meaningfully. Once you learn to see that, you stop asking why the market is moving and start asking how long it has been moving. There's a psychological shift that happens when you trade this way. You stop feeling like you're guessing against the market and start feeling like you're cooperating with it. That cooperation doesn't guarantee profits, but it dramatically improves the odds. Real money creates inertia, and inertia is something you can ride. Fighting it is exhausting. Riding it requires patience and respect. This is also where money management becomes clearer. When you trade in the direction of committed capital, you can place stops where the trend would be proven wrong. That's logical risk. When you trade against it, your risk is based on hope. Hope is not a strategy. The market doesn't reward hope. It rewards alignment. Ask yourself this the next time you see a clean trend forming: who is likely behind this move? Is it scattered retail interest, or is it sustained pressure that doesn't flinch? The answer is usually written right there in the way price behaves during pullbacks. Weak pullbacks in a strong trend tell you buyers are waiting. Sharp rallies in a downtrend tell you sellers are using strength to exit. That's not emotion. That's execution. Once you understand that trends are the visible result of real money committing itself, you stop treating them as temporary accidents. You treat them as conditions, and conditions, once established, tend to persist. Not forever, but long enough to matter, long enough to build a position, long enough to let time work in your favor instead of against you. This understanding also builds discipline, because it teaches you that not all markets deserve your attention. If there is no clear commitment, there is no edge. Flat markets are arguments between buyers and sellers. Trending markets are decisions already made. Why involve yourself in arguments when you can participate in decisions? Over time, you begin to trust price more than prediction, structure more than stories, and commitment more than excitement. You learn that real money leaves clues, not promises, and that your task as a trader is not to be clever, but to be attentive, because the moment you stop paying attention to where capital is truly committed is the moment you begin trading your own imagination instead of the market's intent, and that's usually where the trouble begins, especially when you convince yourself that this time is different. Trends forgive bad timing, counter trends do not, and that lesson cost me more money than any commission ever did. It sounds simple when you hear it stated plainly, but it takes real experience to feel the difference in your account. A trend has momentum behind it. It has pressure. It has commitment from traders who are not thinking in minutes or hours, but in weeks and months. When you step into that flow a little early or a little late, the market often gives you time to be wrong and still survive. When you step against it, the market rarely offers that courtesy. Most traders underestimate how important forgiveness is in trading. They think success comes from perfect entries. It doesn't. It comes from being on the right side of force. Even the best timed trade can fail if it fights the dominant direction. And even a poorly timed entry can recover if it aligns with a strong trend. Have you noticed how often a trade that shouldn't work still does, simply because it's going with the market? When you buy in an uptrend, you're buying into demand that already exists. That demand doesn't vanish because your entry was sloppy. It keeps working in the background. Pullbacks happen, but they're often temporary pauses, not reversals. The market is breathing, not dying. If you've aligned yourself correctly, time becomes an ally instead of an enemy. Now compare that to counter-trend trading. The moment you step against the trend, you're demanding precision. You must be right on timing, right on size, right on exit. There is no margin for error. The trend is still pushing, still applying pressure, still moving capital in the opposite direction of your position. Any hesitation, Any doubt, any delay is punished. Why would you choose to trade where perfection is required? Counter-trend trades feel clever. They flatter the ego. Calling a top or a bottom makes a trader feel insightful, almost prophetic. But the market doesn't pay for insight. It pays for alignment. Tops and bottoms are only obvious after they are well established, and by then, the easy money is already gone. Before that, they are just guesses wrapped in confidence. I've watched traders fade strong trends again and again, convinced that price had gone too far. Too far according to what? A moving average, a feeling, a past price level. Meanwhile, the trend kept advancing, not because it was logical, but because money was still flowing. The market doesn't reverse because something looks extended. It reverses when pressure shifts. Until then, extension is just another word for strength. This is where trends show their forgiving nature. In a strong uptrend, buyers are waiting below the market. They missed the breakout. They hesitated on the pullback. They're eager for another chance. That eagerness creates support. So when price dips, it often finds willing participants. That's forgiveness built into the structure. The market is saying, you were early, but the story isn't over yet. In counter-trend trades, there is no such safety net. You are betting on exhaustion, not commitment. Exhaustion is fleeting. It shows up briefly, then disappears. If you mistime it, the trend resumes and you're immediately underwater. There are no patient buyers waiting to save you. You are standing alone in front of pressure that hasn't finished its work. This difference also shapes how you manage risk. In trends, stops can be placed beyond structural levels that make sense. If hit, the market has genuinely changed its behavior. In counter-trend trades, stops are often tight and arbitrary because you're trying to minimize damage from being wrong. That tightness increases the chance of being shaken out, even if the market eventually does what you expected. How many times have you been right on direction and still lost money? The forgiving nature of trends also teaches an important lesson about mindset. You don't need to rush. You don't need to nail the exact turning point. You can wait for confirmation, enter late, scale in, adjust. The trend absorbs your imperfections. That lowers stress, and lower stress leads to better decisions. Trading becomes less about adrenaline and more about execution. Counter-trend trading, on the other hand, keeps you tense. You're constantly watching for signs that you might be wrong, because you know the odds are against you. That tension leads to impulsive exits and emotional decisions. Even when you win, the victory feels fragile. It depends on being clever, not being aligned. There's also a long-term wealth lesson embedded here. Consistency comes from stacking probabilities, not from occasional brilliance. Trends offer repeatable conditions. Counter-trend setups are situational and rare. Building capital requires you to survive long enough for compounding to work. Fighting trends increases volatility in your results, and volatility is the enemy of steady growth. Many traders say they like counter-trend trades because the risk-reward looks better. What they often mean is that the stop is closer. But a close stop is not the same as low risk. Risk is probability multiplied by consequence. Counter-trend trades have a lower probability of success, even if the reward looks attractive on paper. Trends invert that equation. The probability improves, and the consequence of being slightly wrong decreases. Once you truly understand this, your trade selection changes. You stop asking, where is the top? And start asking, is this trend still intact? You stop looking for reasons to fade strength and start looking for places where strength might resume. You begin to accept that missing the first part of a move is not a failure. It's often the price of confirmation. This acceptance removes a lot of frustration. You no longer feel the need to catch every opportunity. You're content catching the ones that allow for human error. Trading is a human activity, and human error is unavoidable. The smartest approach is not eliminating error, but operating where error is survivable. Trends forgive because they are powered by forces larger than any single trade. Counter-trends punish because they depend on momentary imbalance. One is structural. The other is speculative. One allows you to breathe. The other keeps you holding your breath. Over time, you begin to notice that most of your worst losses didn't come from bad ideas, but from fighting what the market was already doing. And most of your best trades didn't feel exciting at entry. They felt almost boring, because the decision was already made by the market, and you were simply choosing to participate, knowing that even if your timing wasn't perfect, the direction was doing most of the work for you, and that as long as the direction remained intact, you didn't need to be clever. You just needed to stay aligned and let the pressure continue to do what it had been doing all along. Capital protection comes from trading with momentum, and that's something most traders only appreciate after they've lost enough to respect it. Everyone enters the market dreaming about profits, but survival is what decides who stays long enough to ever see them. Momentum is not just a way to make money, it's a way to avoid unnecessary damage. When you trade with momentum, you're putting distance between yourself and danger, even before you think about reward. Momentum means the market is already moving with intent. It's not hesitating. It's not negotiating. It's advancing or declining with enough force that opposing pressure has failed, at least for now. That force acts like a current in a river. Swim with it, and even if you stumble, you're still being carried forward. Swim against it, and every mistake costs energy, time, and capital. Why would you choose the harder direction when preservation is the first requirement of this business? Most traders misunderstand protection. They think it comes from tight stops, small positions, or clever hedges. Those are tools, not foundations. Real protection starts before the trade is placed. It starts with choosing conditions where the market itself helps limit damage. Momentum does that naturally. When momentum is strong, reactions tend to be shallow and brief. That reduces exposure. That reduces stress. That reduces the chance of panic-driven decisions. When you trade without momentum, you're exposed to randomness. Price drifts. It chops. It spikes without follow-through. In those environments, stops get hit repeatedly, not because your idea was terrible, but because there was no force to support it. Momentum acts like reinforcement. It doesn't guarantee success, but it narrows the range of outcomes. Narrower outcomes mean more predictable risk. Have you noticed how your worst losses often come from trades that felt uncertain from the beginning? Trades where you had to convince yourself. Trades where price wasn't really going anywhere, but you felt the need to act anyway. That's capital erosion disguised as participation. Momentum filters those trades out. It forces you to wait until the market has already committed. This waiting is not passive, it's protective. By demanding momentum, you're saying, I want evidence before I risk capital. Evidence reduces guesswork. Guesswork is expensive. The market is full of opportunities, but your capital is finite. Every trade must justify its existence by offering not just potential upside, but controlled downside. Momentum also protects you psychologically, which is something traders underestimate. When price moves in your favor soon after entry, confidence builds naturally. You're not hoping. You're observing confirmation. That confirmation makes it easier to hold positions, follow plans, and avoid micromanaging. Stress decreases, and with it, the likelihood of impulsive mistakes that do far more damage than any single losing trade. Trading against momentum puts you in a defensive mindset from the start. You enter already expecting trouble. That expectation affects every decision. You cut winners early. You hesitate on exits. You rationalize losses. Capital protection isn't just about numbers on a screen, it's about protecting clarity of thought. Momentum helps maintain that clarity. There's also a structural reason momentum protects capital. Strong moves tend to attract participation. That participation creates liquidity. Liquidity allows exits. In fast, directionless markets, exits can be costly. Slippage increases. Volatility spikes without warning. Momentum smooths that process by keeping activity focused in one direction. Focused activity is easier to manage than chaotic movement. Many traders believe that the best protection comes from being early. In reality, being early often means being alone. Being alone in a market is dangerous. Momentum means you are not alone. Others are participating. Others are defending levels. Others are pushing price. That collective action reduces the burden on your individual decision-making. This is why professional traders are often comfortable entering after a move has already started. They are not afraid of missing the beginning. They are more afraid of exposing capital to uncertainty. Momentum gives them context. Context is protection. Without it, every tick feels like a threat. Over time, you begin to see capital protection not as something separate from opportunity, but as part of it. Trades that offer strong momentum often offer clearer invalidation points. If momentum fades, you know it. If it persists, you benefit. Either way, the decision tree is simpler. Simplicity reduces error. This approach also changes how you size positions. When momentum is present, you don't need oversized bets to make progress. Smaller positions can still produce meaningful results, because follow-through does the work. That naturally limits drawdowns. Limiting drawdowns is more important than maximizing returns, especially early in a trader's development. Ask yourself how many times you've tried to make something happen in a market that clearly wasn't ready. That urge usually comes from impatience or fear of missing out. Momentum neutralizes that fear by showing you that opportunities are not rare, they are cyclical. When one move ends, another eventually begins. Your job is to protect capital so you're available for the next one. Capital protection is also about longevity. The market doesn't reward intensity, it rewards endurance. Traders who last understand that avoiding large losses is a form of profit. Momentum helps you avoid those losses by keeping you on the side of pressure instead of in front of it. As this understanding deepens, your focus shifts. You stop asking how much you can make and start asking how little you can lose if you're wrong. Momentum answers that question more clearly than any indicator. If price is moving decisively, wrong ideas are exposed quickly and right ideas are supported. Eventually, you realize that momentum is not an aggressive strategy. It's a conservative one disguised as opportunity. It aligns your capital with force instead of friction. It allows mistakes without destruction. It keeps you participating while protecting you from yourself, especially on days when discipline wavers and patience feels heavy, and the temptation to trade without confirmation creeps in, just as it always does, right before capital is put at risk without momentum to support it.